Hey everyone, Bob Kendall here. Just want to thank you all for watching my videos. If you do want to support the channel, go to www.kendallreport.com/wavetech. Sign up for our software. You get market grid on 165 individual stocks and indices. You also will get 16,500 buy and sell signals on our entire database. I thank you so much for supporting the channel. Those of you who have already signed up, thank you so much. Welcome to the Kendall Report, where I share my 41 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Well, folks, where do you start after a day like yesterday? We actually came in the markets looking like we're going to continue the pattern that we have seen over the last couple of days with the reversal on Tuesday, and all of a sudden rates started to tick up. The 10-year went through some critical levels around 1.5 and just accelerated. It freaked out everybody in the markets, and rightfully so. One of the things I've been discussing for a while is the increase in rates that I've been expecting. I've talked about the 10-year getting to about 1.8. We moved to 1.6 today, but there's something bigger going on, and it's not just inflation. And I did a brief live stream today, and I apologize for the last couple live streams with some of the technical problems that I've had. But the bottom line is that the Fed is losing control of the treasuries. And there's a couple things going on here, in my opinion. First thing is there's mass liquidation and capital flowing out of the United States so fast, it's crazy. It's unbelievable the amount of selling that's going on in the treasuries, and I believe it's just beginning. And tonight's video, I'll go through the 10-year, looking at the yield curve and some of the other things that are going on, but I really think we're seeing the beginnings of something bigger. This is probably the biggest thing that we've seen yet. If you thought COVID was big, if the bond market rolls over in a big way, this will be much bigger. Just think about it for a minute. You have $25 trillion worth of debt laying out there. The corporations are full of debt. All the interest rates start to go up. Prices on the fixed income go down, and it starts to change the pricing of everything, literally. Over the past 40 years, a big piece of my career was in the fixed market. So I'm going to be focused on what's going on in the bonds because I think this is substantial, and we have to watch this very closely. At the moment, we're just seeing a sell-off. We're not seeing that capitulation where we start to see a sharp acceleration to the upside on yields. It's possible that we could spike to 2.5%, maybe 3% on the 10-year in a runaway market where there's just a mass liquidation. This would not probably last long, but it would affect everything we know. All the pricing models, everything gets affected by the cost of money or yields. So this is a big deal, and the treasuries and the debt market in general is so much larger than the equity markets that the equity markets end up to be very secondary in a major sell-off in bonds. Now, we haven't seen anything like this for a while. Going back to the taper tantrum several years ago, there was a pretty good spike and it came right back in. But my problem is that I'm not sure the Fed has much they can do right now. This could be a very big issue. What are they going to do? They're going to buy every bond out there. They're going to buy every asset. Are they going to print another 6, 8, 10, $15 trillion? What's the number? And if they do, doesn't matter. One of the things that I've talked a lot about over the past several years, I know most of you have only been introduced to me in the last year, but one of the things I've been talking about is that we're one bond auction away from disaster. So let me explain what I mean by that. Back in the old days, we used to have where there would be quarterly refunding. So every quarter, they would do a massive refunding of all of the bonds, the ones that were expiring and new money they needed, all of that. And there would be a quarterly refunding. Now, massive auctions happen every week. Debt has grown to such a point that it's almost impossible to fathom the amount of money that has to keep coming in to the bond market to finance this. Now, I spent a fair amount of time talking about MMT. There's so much I could go into tonight. I'm going to stick with just a couple pieces, and on Sunday night I'll go into more detail after I've had time to study some of the effects of this markets and the movements. But there is a major event going on here. Whether it gets systemic or not, we don't know. Let's come back to reality and look at a couple other things that happened on Thursday. We had the claims come in actually better than expected. That was part of the stable markets early in the session. It was really about the interest rates, as I mentioned a few minutes ago. But we also had continuing claims come in around 4.4 million. As I've been saying, I expect that number to stay fairly stable. I think it's out of play as far as being a significant number. We did see GDP come in at 4.1, and some folks seem to think that we're in a recession. We are not. So there's no recession. I realize technical description of a recession is 2 negative quarters in a row. We haven't had that, even though we've got 10.7 million people out of work. So try telling them there's no recession, right? I get that. But from a technical viewpoint, there is no recession right now. There's just a dislocation of a lot of jobs having to do with all the shutdowns. All of these numbers that came out were reasonably positive yesterday, but no one cared about that because of the interest rates. As we look at today, I don't think the market participants are going to be looking at anything except for what the movement is going on in the interest rates. The yield curve actually flattened out a little bit, so I think the Fed came in and was doing some action trying to get that yield curve to come in. It's really starting to expand way too fast, especially in the 530. So as we finish this week, it's going to be interesting to see how it finishes from the stock market's viewpoint as we're trading at some critical levels. I do want to talk about something. In last night's video, I should have laid out better parameters where a failure in the equity markets would be. I did not do a good job at laying that out. I've made a note to myself every night that I need to make sure you guys have a downside pivot number. And the market grid is there. There was some very significant triggers that were out there that did not get reported last night. So going forward, I'm going to do my best to make sure those get out there. The final thing I want to mention is the activity in our database. I'm going to go through this in a minute, but it was substantial, and I've been covering this for a while, and we now are seeing massive liquidation on a short-term basis. On Friday, we update our intermediate models, and I'm expecting to see some reasonable selling there, so be ready for that on Monday, especially my institutional clients. You're going to see potentially quite a bit of selling coming in. As we're at 84% bullish, we're going to have to back off that number of ways to move forward. Let's go ahead and take a look at the chart, see how the market is set up to end this week. Hey folks, Bob Kendall here. I don't want to get too sloppy, but there's so much I had to cover tonight. I'm not going to do a lot of the post effects that I do in these videos. There's just too much to go. It's very late at night, so I want to get this out to you so that you can have the analysis. That's the most important part. I want to wish you a great weekend. We'll see you on Sunday night. Thanks again. As I review the WaveTech database, as I mentioned in the opening comments, we did see 3,684 sell signals and only 350 buy signals. This is a substantial negative rotation. Our database has dropped to 32.31% bullish. There's a couple metrics that I'm going to point out at 27%, and then 22% is where this thing is likely to stabilize. If it does not stabilize there, then we could see a full liquidation, which usually will take us down toward 11 to 7% bullish, which would suggest that we would see a substantial decline from these levels. And then as we come into Friday and we look at the weekly models, right now we're 84.47%. There are 13,905 symbols that have intermediate trends. I suspect this is going to change substantially. We should move back toward a 68 to 62% bullish level. Now this suggests that the longer term trends are still in place. It's not a failure. In fact, earlier On Thursday, we were trading not too far from the all-time highs. Even though we moved off the highs substantially, we're still not breaking down the weekly patterns, but there are a substantial amount of very fragile that have been in place. Some of the longer and mature signals are starting to get very close to exiting the market. Before digging into the indices tonight, I want to cover the 10-year notes, and I want you to see that here on 9/4, back on 9/4/20, our models did issue a buy signal, which was indicating the rates were going to start to increase. And I've been talking about this since this pattern started, and that we're seeing this acceleration. I've also talked a lot about us going toward the 200-week moving average. This is the weekly chart we're looking at, and that is moving closer and closer. As yesterday, we did see the spike high on this market. We did see the spike high at 1.614, and it did back off of there decent. And we also got an RTX sell on the daily, and it looks like we're going to get an RTX sell on the weekly. And what that means, it doesn't mean that it's going to necessarily see rates back off substantially, but it does mean that we should stabilize potentially for the next 2 weeks. As we look at the RTX number, it is 1.45, so we remain above that level today. We will have an RTX sell signal, which will suggest that we will see that sideways movement, most likely move back toward 1.42 to maybe 1.39 as a support level as we come into next week. I'll cover this once we see the grid on Sunday night. But this pattern is substantial. We're seeing a sharp acceleration. I talked about this on the live stream on Wednesday. We've got PPM1 at a plus 5.23. Anything over 0.23 is the trend. This is a very robust trend, which tells us that the probabilities of going back below 1.25 is only about 10% right now. So we're seeing acceleration on all three of the PPMs. This trend of higher yields are going to continue. I also mentioned that there's a potential for maybe a runaway spike and a panic in this market. This market is so big that if there was a panic here, this would just spike this market to insane levels because the market is so big. As I also mentioned, is I don't believe the Fed has anything that it can do here to actually change the trajectory of the short-term yields right now. There's nothing they can do. There's no money they can add. There's nothing they can do. Even also, as I mentioned in the opening comments, I'll continue to cover this in more detail because I do believe that this is going to be the thing that is going to drive sentiment as we go forward, not only in the bonds, but in equities. As I review the S&P futures, yesterday there was some key pivot numbers that I did not mention. What they were for yesterday, and I'll update you for the key numbers for today. Oftentimes I'll talk about the expectations of an R1 S2 number, so let me clarify that just a little bit more, in that if you take out that range, the expected range, then you have to go to the grid and go to the next numbers. Now yesterday was an extreme. As we look at the futures on yesterday, two things happened. We actually got an outside reversal. The futures actually traded to 39.34 high all the way down to 38.10, so 130 points. If we look back just at this week, we traded from 38.05 all the way up to yesterday's high at 39.34, and then traded down almost equal the low back to 38.10. So this has been a crazy volatility day, but the key number was the 38.85. When that was triggered, that signaled a move that we moved toward 38.66, 38.49. This thing was in such a runaway that the liquidation was so heavy it pushed it all the way down through STX. Now, one of the things that we saw happen yesterday, which is somewhat encouraging, 38.50 38.49 is STX. So we do have on the futures an STX buy signal, which suggests we should have some stability coming in the market. But so far overnight, that has not been the case. We've traded down equal to the low that we printed on Tuesday at 38.05. The low actually was 38.0475. We bounced off of that a little bit, but there's still a lot of pressure as we're coming right into the London Open as I'm doing this. So for today, if we look at the grid for today, S1 is 38.05 exactly. So we've had an exact hit on S1. If it gets through that level, the next level is well below 3,800, all the way down to 37.79. And what's happening here is we've seen volatility increase over the last 3 days, and we're starting to see the market grid spread out substantially. And typically what happens then is that we get into a larger, broader pattern and not a full-out collapse, although we are seeing PPM1 right now at a minus 0.26 on the futures, which is in trend mode. But that tells us that the actual resistance is up at 38.91. So you would have to look at the grid from a 38. R2 would be the resistance number that would set up against that number. So today we're looking at R1 S2 number, as there appears to be, there is a probability for this market to take out that 38.05 and trade much lower. Now, on the pivot, as far as the pivot goes for today, the upside pivot is 38.51. If that gets penetrated, then we'll go back to that 10-period moving average, 38.76 to 38.91. That would be the upside. This is going to be plenty of volatility in here, so I'm laying out the sequence from the standpoint of the volatility. Take out 38.05 where we're traded so far overnight, then look for the markets to go through the 38 handle down to 37.79. A quick review of the SPX. We did also get an STX buy signal. 38.62 was STX yesterday. We closed at 38.29. This suggests we should go to an R1 level minimum. That's 39.40. R1, R2 would be the range that you would expect to go back into off of a STX buy signal. Nothing really substantial, but as I mentioned in the futures, we are seeing some follow through. If they do take out that 38.05 in the futures, they could accelerate this thing to the downside. So the range possibilities today, I'm looking at R1, S2, which would be a 38.94, the potential of an S3. The pivot on the upside, 38.40, would set the tone for potential for 39.73. I think we're going to see some monster volatility here, just like we saw yesterday. We did the entire week's range in one day. The next market I'll cover is NASDAQ. As we review the NASDAQ, it was interesting that we did get a short signal on 219 on the NASDAQ. I've been talking about this downtrend for a number of days. I really haven't covered the models, I think, as much as I should have on these index. You can see on the pop-up window that we did have a short signal at 13,639. That signal came in on 219. We did go out yesterday and finish at the 12,831. The key number that we're going to be watching for here will be on the weekly chart. I'll show you here in a minute. We did get down and close and get an STX buy signal as well, although we're seeing quite a bit of follow through on the NASDAQ, and there's a number of things going on. It's probably been 2 weeks now. I've been warning you that Apple and Tesla and some of these big stocks are really on the edge of rolling over, and they've done that. And I don't think this thing is over yet. As we look at the weekly chart, we can set up some expectations for the NASDAQ, and we're very close to at least the minimum, which is going to be that 12,545. I talked about this on Sunday night's video, and this continues to be in play. Now, we're looking at PPMs, and they are rolling over big time. This is potentially the beginning of a very large high-level consolidation. Ultimately, we could head toward the 40-period moving average, but I think there'll be a fair amount of stability at this 12,545 level. If we can stay above that level, right now we are trading above that, and I think we'll continue to stay above that. We have a PPM 2 at 0.56, which suggests there's only a 30% probability for the market to close below that on a weekly basis. This is a weekly chart. So expect to see the market hold these support levels, but set up a larger pattern that ultimately could go down into around the 11,800 handle. That 40-week moving average is moving up, so that's going to continue to be the target for this pattern. But for the moment, let me get this clear, is that you're looking at 12,544 as major support, yet only a 30% probability to get through that level and close below it on a weekly basis. So there should be some bounces off of this level. Probably will be sandwiched between 12,545 and 13,144, which is the 10-week moving average. The final market that I'm going to cover is gold. And we are seeing some substantial selling still in gold. A lot of this has to do with the higher interest rates that are pushing this thing up. Even though folks are talking about inflation, gold's not catching a bid here. And that's telling in itself that there's a liquidation of all assets at the moment. I don't have any clear targets at the moment on the downside. It's likely, though, we could continue down toward the 1725 level, and possibility of actually going through the 1700 level down to 1685. I'll update this after we get the weekly close, and I can do some work over the weekend too. As I mentioned before, that there was a short signal at 1851. It's been short for a while there throughout this whole pattern. I've been talking about this downward sequence and the downward pressure on the moving averages. So we are definitely in a robust downtrend at the moment. As we go to the weekly chart, this is even more prevalent. If you look at the PPMs to start, you're going to see a minus 0.71, a minus 0.4, and a minus 0.03. So the 40-period moving average is just starting to roll. And so this thing is accelerating. The ultimate downside in this pattern would be the 200-week moving average, which is right now at 1547. That would be the extreme. I've been talking about that the pattern still looks like it's bullish. It's going to be down to how we trade over the next 2 weeks and holding some of the levels I just mentioned down around 1724 or so. But we look at the weekly grid here. 1724 is S3, 1707 is the STX number, and this is the final day of the month. So these numbers are all going to get updated. Definitely see more downside once the monthly charts are updated for the grid as we come into the month of March. This will complete the video for tonight. Thank you for watching. We'll talk to you on Sunday night. Have a great weekend, everyone. Hey, everyone. Thanks for watching. If you enjoyed the content, make sure you subscribe, hit the like button, and hit that notification bell so you'll know when I post my next videos and when I do my live streams. Thanks again for watching.